Hi, this is the RITE Report Show, and I'm your host, Chris Angle. I'm the author of 4 books on philosophy, one of which is the Philosophical Equations of Economics. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and Tufts, and he's an independent venture capitalist out on the West Coast. Good to see you, Rick.
And you.
Approximately once a month, we put out a report on the state of the stock market and the economy, and the program uses as its basis the RITE Report, spelled R-I-T-E, which can be seen at www.stock-market-direction.net. And this is a natural outcome of the book with the title that I just mentioned, The Philosophical Equations of Economics. And the RITE Report generates indices from the monthly compilation of corporate, business, economic, and political news, and that they have a directional bias inherent in the headline. And these news indices are used as factors for prognostication of the market direction. And hopefully, investors can use it also to employ hedges according to what we see as the market direction for the coming month. And so we're going to start that by going over, and we'll open up the RITE Report. Let's see. And let's go down to first the macroeconomic snippets. And from the U.S. Census, we're going to go, the first ones are the negative economic and business data snippets, and the first one is that the U.S. retail food sales services for April were unchanged, and also from the U.S. Census, privately owned housing starts in April was 9.5% down. The Chicago Fed National Activity Index declined to a positive 0.24. It's still positive, but since it declined, we're going to place that in the negative column. Sales of new single-family houses in April were down 5.9%. New orders for manufactured durable goods was decreased 1.3%. Personal income decreased 13.1%, and consumer spending, although increased 0.5%. Also from the Bureau of Economic Analysis, economic impact payments established by the American Rescue Plan, those payments declined. From the U.S. Census, at the end of month inventories was down 1.6%. Also from the U.S. Census, advanced international trade deficits in goods decreased in April, and new orders for manufactured goods decreased 0.6%. And now the positive ones. So we had 10 negative snippets, and on the positive side, fewer Americans filed new claims for unemployment benefits last week. And let's see, so from the Conference Board, the Employment Trends Index significantly increased in April. The index now stands at 105.44. And from the Bureau of Labor Standards, U.S. business applications were up 8.9%. U.S. total business end-of-month inventories was up 0.3%. And U.S. total business sales was up 5.7%. U.S. selected services total revenue for the first quarter had an increase of 2.4%. Conference Board measure of CEO confidence is up. It was at 82, up from 73. and marks the highest level of CEO confidence recorded since the measure began in 1976. From Europe, the world trade volume in goods increased again by 2.2%. And real gross domestic product increased at an annual rate of 6.4%, as we heard from the Bureau of Economic Analysis. From the Kansas City Fed, regional economic activity increased again in May. And from the U.S. Census, we already did that one, the end of month inventories. Total construction activity was 0.2% up, and total non-farm payroll employment rose by 559,000 in May. So we see that in May, our total number of snippets was 46% negative and 54% positive. And now we go to our economic analysis indicator summary. The high yield bonds decreased slightly, so that means the interest rate went up a little bit, the yields. So we're going to put that in the negative column. The iShares Select Dividend Index went down just slightly, and these are as of June 7th. We're not. That was a week ago or so. So ISM Purchasing Manager Index saw the economy expanding, and the IHS Purchasing Managers Index also saw economy expanding. Construction spending was up 0.2%. The unemployment rate decreased 5.8%. There's a positive. The civilian labor force participation rate decreased to 61.6%. It's a negative, but it's going to be outweighed by the employment population ratio, which increased to 58%, and the employment trends index from the conference board was positive. So overall, we give that a positive. Bureau of Labor Standards showed that productivity increased 5.4%, output increased 8.6%, and in manufacturing, productivity decreased 1.7%, but output increased 1.4%, and as a whole, we're going to put that as a positive. U.S. manufacturing corporations' after-tax profits were down, so there's a negative. Advanced estimates of U.S. retail and food service sales was up, so we're going to give that a positive. Combined value of distributive trade sales and manufacturer shipments was up 5.7%, and the all-important industrial production index from the St. Louis Fed had an uptick, so that's a very important positive. And the velocity of money, also from the St. Louis Fed, downticked, so that's a negative. New residential construction was 0.3% up, and as we in the conference board leading economic indicators, we increased, and its coincident economic indicators increased. New residential sales were down 5.9%, and new orders for manufactured durable goods was down 1.3%. Existing home sales was down 2.7%, and real GDP was positive 6.4%. Personal consumption expenditures up 0.5%. Personal income decreased 13.1%. Consumer Confidence Index decreased. Restaurant Performance Index was at 106.3 and expanding. So glad to see that back going up. Profits from current production had a decrease of 31.4 billion, and new orders for manufactured goods in April decreased 0.6%. World trade volume, as we mentioned already, is up, and Chicago Fed as National Activity Index, as we mentioned, was positive 0.24%, but it was down from the 1.71 in March, so we're going to give that a negative. Housing prices rose nationwide, up 0.9%. We're going to give that a positive. And so we have 16 positive indicators, 12 negative indicators, and so we're going to put that into a summation here of and derive a strategy index. And our domestic political risk, Democrats are of course in control of the government, and their rhetoric indicates a preference for future tax increases, but it remains to be seen if this can be effectuated, as the Republicans are 100% united against tax increases, along with maybe one or two Democrats. So this is kind of it's unknown how this is going to play out. So we're going to give that a -5. Total taxes remain in place, which is good. We're going to put that as a neutral. Individual individual incentive. Regulations are increasing in this administration, so we're going to put that as a -3. And production of knowledge is a +8 because government and corporations are spending money on research, and the government plows money into this sort of thing, which is good to see again. Technical analysis of this market is positive. Market continues to go up overall, but there is some choppiness and fear of rising interest rates and potential inflation, so we'll give us a +6. Our business and economic snippets were, as we pointed out above, are predominantly positive, and so our economic indicators are 16 positive, 12 negative, and we've made a sum of that, and we come out with our index to be 59.3%, as 50% is neutral. So we see the stock market in a positive light here. And so our strategy continues to be positive, and the Dow is up, and although just barely from last month, so actually just a slight decrease. But I think as of today, it's positive. And so the summary for at least my side, we'll see what Rick has to say about this in a second. The market is now recovering due to positive business and economic news, along with positive COVID developments in the administration for the vaccines of the COVID-19. And although the RITE Report indicators decreased slightly this month to 16 positive economic indicators, the strategy index remained essentially at the previous level at 59.3%, only decreasing from 60%. Thus, economic activity is seen to increase, and as such, we're going to call that to stay long. However, there's another aspect to here, and we got to talk about inflation a little bit. The inflation is up, and the consumer price index is up, and so we're going to perhaps discuss that here in a second. Although the RITE report sees an increase in the economic activity in the next month, and a corresponding increase in stock market indexes, it also sees a danger in inflation as the Commodity Research Bureau Index for the second month has exceeded the 200-point mark, which is up significantly from last year. This Commodity Research Bureau Index is believed by the RITE Report to be a reliable harbinger of inflation. Thus, the report recommends to add an additional hedge against inflation to portfolios, and this can be done in a variety of ways, including the use of physical gold, gold ETFs, gold on the futures market, or other commodities and commodity indexes that are linked to inflation. Enough said by the RITE Report. Let's see what Rick has to say about the future of the stock market and the possibility of inflation making an influence upon it.
Well, I continue to view this as a trading market. The valuations are priced for perfection. Amazon's trading at 60 times its price earnings ratio. These are levels we last saw during the Japanese bubble. Real estate's and housing's obviously in a bubble. Commodities are all in a bubble, almost across the board. And that accounts in part for some of the negative readings you're seeing. The fact that there are any negative readings at all at this early stage in the recovery, relatively early stage in the recovery, should be alarming. The political imperative, of course, will be to keep real interest rates negative through next year in November. So the risk has to be that the Fed keeps monetary policy loose for too long, and inflationary expectations become habitual, shall we say, and an expectation at large. On balance, the risks are continuing to rise, some of which have been cited already by Chris. In addition to inflation, the regulatory risk is I don't believe it's been priced into the market. I believe this administration views big oil as in the same light as prior administrations viewed big tobacco, something to be destroyed. Whether they can do it through ESG mandates, like those being adopted by BlackRock, or by severe regulations. What we are seeing, in fact, is that oil exploration has declined markedly. Very little investments going into that. So oil prices will continue to rise for the foreseeable future. That will have obvious political implications and economic implications. And I think the current government is quite happy with that situation. In fact, they would like to see additional taxes tacked on as well. So generally speaking, consumers should expect to see, $5 and $6 per gallon gas prices in the coming months, depending on where they are in the country, and that will have political implications for next year. In addition, there are other risks, though, on balance, that are increasing. China continues to maintain that they will invade Taiwan. They haven't cited a time frame, but there's circumstantial evidence indicating that they will have the materiel and personnel in place by early next year. I don't see why they wouldn't, given that we have a weak president who obviously wouldn't intervene, and that the United States military has already admitted that there's virtually no way that they can protect Taiwan from where we are here on this side of the Pacific. So the invitation is there for the taking. Taxes, I believe taxes will go up, are going up. They're already going up at the state level for many of the blue states. I don't think Schumer will fail to use some sort of budget reconciliation gimmick to raise as many taxes as he can. The most threatening, obviously, being the capital gains tax. He probably won't get to 43%, but there'll be some substantially higher level. And that has, of course, a direct impact on returns for investors. So that will dampen enthusiasm for investing in a whole range of assets, very obviously. And that's just a dead net loss. And so some of these issues have not yet been anticipated by the stock market, which is kind of slow to react. But as they become clearer over the course of the summer and into the fall, it seems highly likely that the market will remain pretty choppy. I don't see any possibility of a straight line up from here. I see rotational plays. I see some opportunities in cyclicals. I think oil companies will do well. I think other overpriced stocks in tech and elsewhere need to be reassessed and repriced. Finally, I would say that it's very indicative that the European Union was so enthusiastic about the Biden visit. They are all about managed decline, and to have a president in place that is a friend of managed decline through increased regulation, through kowtowing to Russia and China, through relying on discredited global organizations like the UN with its catastrophic handling of COVID, through not holding China accountable for actually allowing this virus to escape from a lab, which was funded by the United States. All of this speaks to the swamp at its worst. And this is what the European Union embraces, and that's why they will continue to decline. That's why they will continue to have a record unemployment, and that's why they will continue to have lower growth. And as we follow their policies, we will inevitably experience the same.
Pretty gloomy, Rick. You've got we've noted the gas market, the gas for cars is going to go up, and so that'll have possibly an influence on the market. Taiwan, an invasion of Taiwan on the horizon, that would certainly devastate the market, and of course, capital gains taxes are on the table. So, do you have a time frame when these things might come about and influence the market, as all these things can really give it a good whack?
Well, remember the capital gains tax proposal is supposed to be backdated to April. So it's not going to be implemented for next year. When it passes, it will be backdated to April of this year. So that will cause, once it passes, whatever form that takes, that will have an immediate impact on the market. As for China, hard to say. I suspect before the end of the year we'll see them move in one fashion or another on Taiwan. And none of that is convenient for Biden's November election prospects. And even though, yes, the Fed is going to try to keep interest rates extremely negative, increasingly negative through next year, November, you'll get pressure from the bank to, for relief, because they can't tolerate negative real interest rates indefinitely.
Okay. Very interesting. So, in fact, we should reconvene next month and see what this situation looks again as we get closer to these contingencies and possibilities and influence on the market. So, thanks very much, Rick, and we'll see everybody next month.
Thank you.